Hello, and welcome to today's webcast, Private Equity Funds Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the slide deck and handouts widget. You can ask questions by typing in the Q&A window and clicking submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our slide deck and handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, with that, I'm pleased to turn it over to today's presenter to get us started. Dylan?
Good morning and good afternoon to everyone joining us on the East Coast. My name is Dylan Peters. I'm an audit senior manager in our private equity venture capital practice out of our San Francisco office. I'd like to welcome you to our 2024 Private Equity Funds Update. We have a very packed and fast-paced hour ahead of us, so I'm going to go ahead and go through the agenda and introduce some of our presenters. So we're going to kick off the presentation with a 2024 private equity market update and outlook for 2025. That's going to be presented by Sterling Smith, a director in our private equity group out of Dallas, Texas. Next, we will be joined by Allison Kelly, who will be giving us a regulatory update and the impact on private funds. She's a senior manager out of our Seattle office. Next, we will have a tax section presented by Ashley Sievers, senior manager out of Spokane. And we will wrap up the hour with a presentation on valuations in a high interest rate environment. That'll be presented by Diego Torres out of our business valuations group in Rancho Cordova, California. As mentioned in the housekeeping items, if you have questions, please use the chat function. We'll do our best to feed those to the presenters as they come in. But if we don't get to your questions during the presentation, we'll make sure to follow up directly via email after the session. With that being said, I'm going to go ahead and pass it over to Sterling, who's going to get us kicked off.
Good morning, folks. Before we jump in, I just want to kind of create a little perspective. Again, I'm in a business development executive with Moss Adams. Primary goal is to help promote Moss Adams services. My focus, again, mainly private equity, portfolio companies, and then also work with a lot of investment banks in terms of just overall deal flow. And, M&A is, again, where I primarily spend the majority of my time. With that quick introduction, we're going to actually kick off here with the polling question.
All right, thanks, Sterling. Yes, polling question number 1. LPs continue to allocate to private credit strategies, which have drawn what percentage of fund inflows year-to-date 2024? A, 30%, B, 50%, C, 70%. I'll give everyone a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. All right, we'll give everyone just a few more moments. And here are the results.
Okay, interesting. I think most on this call will be surprised to hear the actual answer is 70%. So over the last, call it 18 months, there's been a rotation from limited partners to general allocations to what's called alternative investment classes. So again, I guess maybe a little surprise to most of the folks here just based on the responses. And a little bit of context, PE fundraising has been strong this year, 2024 year to date, comparable to what we saw year to date 2023. It just happens that the private equity investment has really gone to larger fund managers and has been a little more troublesome for the emerging managers. And then another note is that within private equity capital raising, again, private credit strategies, we've actually seen extended timelines for fundraising from, call it 11, 12 months to an increase to more of 18 to 22 months. So again, fundraising is taking a little bit longer, but you're really seeing LPs reallocate, if you will, to private credit. And there's some underlying nuances there, which, really lend themselves to more defined liquidity parameters for private credit, again, being debt instruments versus liquidity, let's say lack of liquidity payouts from GPs that we've seen in the recent past. Okay, I'm going to approach this from really call it the good and the bad. So again, not to be dire, as I think private equity is doing very well as in the alternative investment class. We've just seen overall this year what I would call a lackluster of deal activity. And it's really kind of tough to compare it to 2021, which was really a golden year, and even 2022, which had an overlay of deals that didn't get in 21, completed out in 2022. But really, if you really look at kind of mid 22 to date, so let's call it roughly 24 months, it's been a tough slog for private equity investors, particularly in the area of trying to invest in platform entities. And really the big driver for that is, one, less PE groups selling their holdings, and founder-based businesses, just in general nature by number, are smaller. So they tend to be finding themselves more in the add-on acquisition category. So this isn't to say that private equity has, quit investing. It's just been a shift into a lot of smaller roll-up consolidation type add-ons versus the larger platform entities. Diligence, financial performance scrutiny, we see it every day in the underlying work that Moss Adams provides to its clients on QV and tax diligence. And this is leading to longer closing timeframes. So LOIs that are written with 90-day exclusivity with, call it 30-day extensions. We're seeing a lot of deals pass way beyond what I call the 120-day extended time frame, maybe getting closer to 5, oftentimes even to 6 months. So deals are getting done, it's just taking longer to close them, just with a higher bar. I think it's safe to say that COVID is in the rearview mirror for most investors, underwriting new investments, but growth and margin are definitely center of the bullseye for most of the professional investment managers. Structure over the last 2 years has definitely been more challenging for the investors, or not, the sellers. We're seeing, a combination of rolled equity, seller financing, earnouts. On the rolled equity piece, there's usually a good argument for that, for the alignment of interest. Seller financing is an indication of just higher debt costs and trying to balance that out in just the current interest rate environment. And then the dreaded earnout, it's just something that, I, as a former investment banker, never wanted to see in my deals when I was helping a client sell their business, just for a multitude of reasons, which we won't get into today. But, this confluence of all three factors are really kind of making deal negotiations achievable, but definitely drawing out the timelines. We've seen over the last, call it 18 months, more activity in the independent sponsors. And when this goes under the bucket of ugly, it's really more just from a competitive situation. So if you're working for a private equity group and they're out in the market sourcing new deals, you're seeing another entrant, if you will, as well as the direct debt lenders. As we looked at on the polling question, with the amount of capital going into direct lending, that's really put more pressure on what I call deal availability. And it's also causing certain business owners, again, not usually non-private equity backed, to really look at options in which to finance a business without giving up control and equity dilution. And again, I know Moss Adams works with a lot of direct lenders in their diligence, and this is really kind of leaning more to what I call the unsponsored deal dynamics. I think everyone on this call can probably agree that we've got some uncertainty in our economy with the presidential elections coming up. And then when I was actually writing these notes was, 2 or 3 weeks ago, thinking through, is a recession a legitimate fear for, all? And I'm not going to be a pundit here and with a crystal ball that's fuzzy and say, soft landing is guaranteed. But some of the volatility we've seen in the market 2 weeks ago, it shows that people are pretty edgy on, is a recession possible if the Fed doesn't change interest rate stance in the near future. And the last comment I'll just kind of hit on is holding periods of PE-backed companies, where the average is probably 4.5 to 5 years. We've seen with the slower M&A environment, particularly with private equity liquidating their investments, that period is ticking up to more to 6.5 to 7 years. So more on the positive side, in my day-to-day travels, I work, again, a lot of investment banks, brokers. We are seeing a lot more companies being prepared for processes. And that's both founder-owned businesses with non-institutional backing, as well as private equity-owned businesses. Buyout activity seems to be coming back around. Again, you read this data source, hear this report. It feels like we're getting back to what I would say a more normal LBO buyout market. Again, private credit, I've already touched on. There's a lot of capital coming into that has allocated more dollars toward sponsor finance transactions. The bank markets have opened up in the last, call it 6 months. So it's a more conducive environment for your traditional LBO transactions. We're seeing more in the way of carve-outs, lift-outs, and this is applicable to what I call a subset within private equity. Generally speaking, not all private equity are created equal, and not all are designed with the skill sets or the comfort zone of going into more complex carve-out transactions. That said, you're seeing a lot of corporate rationalization, and it's leading to more deal opportunities. And given where we've been in terms of lack of quality investment, we're seeing more and more of the we'll call corporate rationalization carve-outs. Continuation funds. I'm not sure if most or what percentage of the people here on the phone have interacted with or are familiar with continuation funds, but it is a way for a GP to basically recapitalize a portfolio company, pull it out of a fund, put it in a separate purpose vehicle, continue LPs, bring in new LPs, and kind of set a new valuation, new mark, new holding period. There's probably been about 120 of these transactions since the start of 2023, and it seems to be becoming a little more accepted vehicle for a liquidity event. I know I see it in my book of business. I see it across the firm. Again, Moss Adams being representative of, a top 15 national accounting firm, that we're seeing private equity spend more inward energy on process improvement, merger integration, ERP implementations, really kind of doing the things they need to create greater value within the portfolio companies they have. And again, I just think this is an indication of a very active M&A environment, 21, 22, a little bit of a hangover, and really kind of making sure that they're preparing their companies for successful exits. And then I know I kind of touched on the election earlier. It's even on the next page. It's kind of a big theme. The good thing is the election will be over in early November. I guess what we really have, what's going to happen coming out of the election in terms of policy change, we will have to see. But at least that'll take some risk in what I call a major headwind that everyone I'm talking to is mentioning here in the coming next 2 or 3 months. So looking forward, the factors that I'm hearing again in the daily conversations, the conferences I attend, I think founder and PE seller optimism is going to be the most important. Until sellers are feeling good about releasing their businesses, I think we're going to be kind of lackluster. But I think like anything, once the tidal wave starts, the momentum will just carry. And I know just from a time sensitivity, I'll just touch on really kind of one major theme that's encapsulated in a couple of these bullets is interest rates, Fed funds, and cost of debt capital. Again, how quickly the Fed lowers rates, what the kind of cadence is of rates, the indications to the market of, or is that cutting rates because of recession fears or labor markets? There's these dynamics that a lot of people are really focused on. You see it in the news, you see it in the stock market. I think as we get a little more comfort on a path that's going to de-risk the overall private equity deal-making environment, which will help accelerate, new investment activity, and again, seller optimism to liquidate more assets. With that, I will turn it over to Allison.
Great. Thank you, Sterling. Hello, everyone. As Dylan introduced me at the beginning, my name is Allison Kelly. I'm an audit senior manager in our Seattle office, and my clients are primarily in the private fund space. Today, I have the joy of giving you the regulatory update. Before we get started, as a disclaimer, the intention of this section is to not provide compliance advice, but rather to provide awareness of some of the various rules that could be impacting you today. As you might expect, there's nuance to different people's situations, and things are continuously evolving. With all that said, let's jump in. The biggest topic of conversation for over a year now has been on the private funds advisor rule. To summarize the order of events, this was first proposed in February of last year, was formally adopted about a year ago, and became effective in November of 2023. However, a few months ago, on June 5th, that rule was vacated. Prior to the rule being vacated, here's a brief summary of the different aspects of the rule and who they applied to. As you can see, there are two main categories of rules: those that apply to all private funds and those that only apply to private funds managed by registered investment advisors or RIAs. All funds were prohibited from engaging in certain activities and practices unless disclosures and/or consents were obtained from investors. Similarly, all funds were prohibited from providing certain types of preferential treatment unless disclosed to investors. Those funds that are managed by an RIA had additional requirements as well. Specifically, they were to be required to provide quarterly statements with certain information, obtain an annual audit, and obtain a fairness opinion or valuation opinion in connection with any advisor-led secondary transactions. As mentioned earlier, on June 5th, the United States Court of Appeals for the Fifth Circuit vacated the new private fund advisor rule. the court found that the SEC had exceeded its authority under the Administrative Procedures Act. So as of this date, those rules are no longer in place. Outside of those rules, there are a few additional rules that we'll go through today. In February of last year, the SEC proposed a new rule to address how RIAs are safeguarding client assets. In September of last year as well, they also adopted amendments to the names rule. And in November, they released their priorities for registered investment advisors and broker-dealers. Now we can talk about each of these in a little more detail. First is the safeguarding rule that was proposed in February of last year. While this rule has not yet been adopted, the comment period for the rule has ended. The proposed amendments are designed to modernize the scope of assets and activities that would trigger application of the rule. Specifically, the rule would specify the types of assets subject to the safeguarding requirements by including all client assets as opposed to only funds and securities. This would include all other assets such as crypto, physical commodities, real estate, financial contracts held for investment purposes, and other assets that are not currently clearly covered by the custody rule. Under the proposal, the written agreement would require two provisions that aren't explicitly addressed by the current rule. The first provision would require the qualified custodian to provide promptly upon request records relating to client assets held in account at the qualified custodian to the SEC or to an independent public accountant engaged for purposes of complying with the safeguarding rule. The second provision specified the advisor's agreed upon level of authority to effect transactions in the account. The proposed rule's written agreement requirement would also incorporate and expand two components of the current rule: account statements and internal control reports. Under the account statement rule, the written agreement must contain a provision requiring the qualified custodian to deliver account statements to clients and to the advisor, as currently advisors must have only a reasonable basis for believing account statements are provided. The internal control report provision would require the qualified custodian to obtain a written internal control report that includes an opinion of an independent public accountant regarding the adequacy of the qualified custodian's controls. Next up, we'll talk about the amendments to the fund names rule. Because a fund's name is typically the first piece of information that investors receive about a fund, its name offers important signaling for investors in assessing their investment options. The amendments to this rule are designed to ensure a fund's portfolio aligns with its name. To that end, if a fund has a thematic name, it would be required to adopt an investment policy such that 80% of the fund's investments would conform to that strategy. This could be a particular type of investment, a focus in an industry, country, or geographic region, an overall strategy such as growth or value, or that the fund is tax exempt. For all these, it should be consistent with the plain English meaning or established industry use of those terms. The amendments also require a fund to perform a quarterly review of its assets to ensure compliance with its 80% investment policy, with the further requirement that any necessary changes to conform to the policy be completed within a specified time frame, generally about 90 days. The amendments will include enhanced disclosure requirements over terminology used in fund names, particularly related to alignment with industry standard and plain English meanings. Additional reporting and record-keeping requirements regarding compliance with the names rule are also included in the amendments. This rule became effective in December 2023, and compliance with its requirements depends on the size of total assets under management. Specifically, if you have in excess of 1 billion AUM, then you have 24 months from the effective date to comply. Whereas if you have less than that, you have an additional 6 months or 30 months total from the effective date to comply with the provisions of this rule. Each year, the SEC Division of Examinations releases its annual priorities for its examinations of RIAs and broker-dealers. Those priorities for 2024 were released at the end of 2023. Today, we'll focus on those priorities for investment advisors to private funds. If you're familiar with priorities that were previously announced in other years, these should look fairly consistent. Let's walk through each of these priorities. First, a focus on portfolio management risks presents when there is exposure to recent market volatility and higher interest rates. This may include private funds experiencing poor performance, significant withdrawals, and valuation issues, and private funds with more leverage and illiquid assets. Next, adherence to contractual requirements regarding limited partnership advisory committees, including adhering to any contractual notification and consent processes. Then, a focus on accurate calculation and allocation of private fund fees and expenses, both at the fund level and the investment level, including valuation of illiquid assets, calculation of post-commitment period management fees, adequacy of disclosures, and potential offsetting of any such fees and expenses. Next, due diligence practices for consistency with policies, procedures, and disclosures, particularly with respect to private equity and venture capital fund assessments of prospective portfolio companies. Another focus is on conflicts, controls, and disclosures regarding private funds managed side by side with registered investment companies and use of affiliated service providers. Then, compliance with the Advisors Act requirement regarding custody, including accurate Form ADV reporting, timely completion of private fund audits by a qualified auditor, and the distribution of private fund audited financial statements. Finally, policies and procedures for reporting on the Form PF, including upon the occurrence of certain reporting events. Here you'll find a number of links to articles, and when these slides are distributed out to this group, you'll have access to those. And next up, here we've got our next polling question.
All right, thank you. Yes, polling question number 2. How well prepared is your fund to implement the recent SEC adopted and proposed rules impacting private funds? A, fully prepared. B, somewhat prepared. C, not prepared. D, proposed rules not applicable. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And we'll give everyone just a few more moments to respond. And here are the results.
Great, thank you. Well, it looks like it's split. You know, at least some of you are somewhat prepared, so hopefully today helped. You know, and maybe for some of you, those rules aren't applicable at this point. So with that, I'll be handing it over to Ashley to give us the tax update.
Good morning or good afternoon, depending on where you are. Like Dylan said, my name is Ashley and I'm a senior manager here at Moss Adams. So we'll chat today through some tax updates and some, ongoing court cases. First topic here is the Tax Relief for American Families and Workers Act of 2024. It was passed by the House back in January by pretty wide margins and seemed, a pretty good bipartisan effort, honestly. It then sat at the Senate, and Chuck Schumer didn't believe he had the votes to get it through, and he was in fact correct. At the end of July, it was voted down. General media has pitched this as the child tax credit, and I even had a pop-up yesterday that wanted me to read an article about that. But the broader implications here are for businesses. Some key provisions are to restore immediate expensing of domestic research and development costs, reinstate 100% bonus depreciation, and restore the add back of depreciation, amortization, and depletion when determining your IRS Section 163J business interest expense deduction. The provisions would have been retroactive and extended through 2025. So we're just going to have to wait and see what happens on that front. Next here is a Loper Bright case. It's gotten a lot of attention in 2024. The Supreme Court issued an opinion on June 28th that overturned a 40-year precedent on the federal agency's interpretation of Chevron. So under Chevron, if a statute is really ambiguous and the interpretation is based on a permissible construction of the statute, the court must defer to an agency's interpretation. So the judges in this case argued that that is for the courts to say what the law is, and Chevron has made it too easy for the courts to find ambiguity in the text and then defer to the government agencies. They argue that it tilts too much power for the government, whereas these government agencies feel like they are the experts, and Chevron allows them to give weight to topics in which they can provide their expertise and use that additional judgment they have based on their job titles and experience. The decision here now requires that the court exercise independent judgment when looking at an ambiguous statute. And unfortunately, there is no exception for highly technical statutes. For example, the Internal Revenue Code. The effect of the case is also immediate. There was a tax court judge, Elizabeth Copeland, who stated that she will now give substantial weight to statutory interpretations expressed in Treasury regulations. She also assumes that other tax court judges will do the same going forward. Next case here is Sorbonne Capital Partners. And essentially, there's IRS section 1402 requires self-employed individuals to contribute to Social Security and Medicare, but there's a specific exception known as the limited partner exception. Sorbonne is a hedge fund manager with 4 partners, and guaranteed payments as well as ordinary income was allocated to all partners, and those limited partners did not pay the self-employment tax. Ultimately, the court decided that limited partners of a state limited partnership are not qualified under that limited partner exception simply because they're called limited partners. The court ruled that a functional analysis test should be applied to determine actually if those limited partners do qualify for that exclusion. What I have found really interesting in this entire case is that the term limited partner is not defined in Internal Revenue Code section 1402 or in any Treasury regulations or anywhere else in US tax law. In the late 90s, there were proposed regulations to define the term, but they were seen as exceeding some of the authority that Treasury has. And ultimately, nothing was done with those. And here we are 30 years later. There was a recent update last Monday. A taxpayer filed a brief in a case called Serious Solutions, which is essentially an appeal of this entire outlook. And this Serious Solutions brief provides several compelling arguments, the best of which discusses why the tax court made an error in determining, there's a phrase in there, limited partner as such, which requires this functional analysis. There's also 2 other cases out there similar to this Serious Solutions case that are essentially an appeal here. So we'll have to see how all of those pan out during the rest of the year. Next here, we have a Senate hearing on tax reform that happened in June of this year. The carried interest loophole was brought up again. There's really no shock there. It's come up time and time again. In 2022, the Inflation Reduction Act did include changes to the carried interest rules, but they were scrapped very late. So it's just a continued hot topic. I don't see it going away anytime soon. Next item here is the Corporate Transparency Act. The intent of the act is to prevent certain individuals who have malicious intent from benefiting from ownership of U.S. entities by requiring them to provide information about the beneficial owners. This is a concern for both, economic stability and even as far as national security. So a beneficial owner under the Corporate Transparency Act is someone who directly or indirectly holds significant ownership, and that's usually defined as 25% ownership or similar control over the entity. It also includes individuals that have substantial control over a reporting entity. So substantial control includes most senior officers in that company. The Corporate Transparency Act was effective 1/1/24, and entities must provide their beneficial ownership and related information like name, address, birthday, driver's license, passport number, and jurisdiction of those documents. If you are a business that was opened in 2023 or prior, you have until January 1st of 2025 to file, so you've not yet missed your deadline. Any businesses established during 2024 are required to report within 90 days, so not a very wide window there. And then businesses established on January 1st, 2025 or later have only 30 days to file with FinCEN. So a pretty tight window there, and really should be under consideration as soon as you're thinking about starting a business. There's no annual requirement update at this time, but changes to your owner information have to be reported. So this can be quite an administrative burden, because if any of your owners or your officers move, get a new driver's license, get a new passport, you have to then report that to FinCEN. So it's something to be aware of, because the changes like that happen all the time. The IRS has had increased focus on high net worth individuals. The first focus the IRS had was on high net worth non-filers, but they are expanding the focus to include those that are filing at this point. The Inflation Reduction Act funded a lot of new IRS agents, as well as agents that have more knowledge and better training and expertise. So this is causing an uptick in audit frequency, and the auditor specialty is making things more difficult for people who are intending to not pay the tax that the IRS thinks they should. There was an IRS press release from this summer that said the IRS has collected over $1 billion with a B dollars from high net worth taxpayers as a result of these recent enforcement actions. And for the IRS, their threshold, their high net worth threshold for income was $1 million, but that is being widened. What I thought was interesting is the IRS is using AI to identify underreported items, and it sounds like that process is going rather well for them. In addition, there have been a formation of specialty teams to examine complex partnerships and really focus on abusive transactions for things like basis shifting or other complicated items there that they hadn't looked at with as much focus in prior years. In terms of what the taxpayer should be doing, I have no new earth-shattering ideas for you. You just need to make sure you have the right tax structure, maintain robust documentation, and if something seems too good to be true, it probably is. There's also been a big crackdown on business expenses for luxury goods like luxury vehicles, corporate jets, and yachts. In addition, if you are a non-filer, you can have a special treat from the IRS if you continue to just ignore the IRS. They can prepare a substitute return for you and file that return, and eventually, if you continue to ignore them, file a levy or a lien. And they don't have the benefit of knowing all of your expenses and deductions. They only know your income. So those can be quite hefty if you choose to ignore your friends at the IRS. Next case here involves Form 5471. And 5471 is generally required to be filed by U.S. entities that have foreign investments where the U.S. entity owns more than 10% of the foreign investment. So if you miss filing a Form 5471, it is a $10,000 penalty per required form per year. So that can add up quickly. This particular court case was about the ability of the IRS to assess that $10,000 penalty. And ultimately, it has been determined that the IRS can assess that $10,000, like I said, per form per year. So if you have investments in foreign corporations, you need to be mindful if you're triggering one of the Form 5471 requirements. In terms of TCJA changes, I've kind of already touched on these. Section 174 with no deduction for research and experimentation costs, is just a continued drain on cash flows for businesses. Entities are still being limited by business interest deduction, and businesses are continuing to feel it more and more as bonus depreciation has started to phase out. The next slide here is just some other considerations. International investments have increased disclosures that need to be identified up front so that we don't have any surprises come tax time or later. We need to understand the offshore portfolio companies and understand if they are passive foreign investment companies or PFICs. Those companies should be providing you with a statement of whether they are or not. If they don't provide that, at the very least, provide you quarterly financials so that an analysis can be performed to determine if they are a PFIC or not a PFIC. You also need to be mindful of a 926 disclosure. That occurs when you put money into foreign investments. And you need that disclosure on the year that that money is contributed. One caveat there, if you have a safe and it converts, that conversion is deemed an equity contribution. So you would be required to file a Form 926 that year, even though you gave the actual cash in a prior year. We've covered 5471. There could be first year tripping points on this. So you might have to have Form 5471 and only disclose it in the first year and then it falls off. But because of that large penalty, you don't want to miss that disclosure. Effectively connected earnings could be subject to withholding of 30%. So be mindful of those. That funds and foreign investors can both put blockers in place to help mitigate this, but that should be discussed ahead of time so that there can be pretty good strategy around that. For unrelated business income tax, if you have debt and you use it to purchase investments, it probably creates a UBIT issue for your tax-exempt partners. Even if you have a line of credit that you use for various reasons, you should be mindful of the timing of when you're pulling money from that line of credit and when you're investing cash into investments, because that could unintentionally trip UBIT for your tax-exempt entities. And you didn't, that wasn't your intent. You didn't mean to. So just be mindful of that. Effectively connected earnings, you can set up blockers for your tax-exempt entities to help with this UBIT issue. The last item here is qualified small business stock. And just a quick note that we really think you should get ahead of exits on this and actually understanding which tranche of an investment is QSBS and which are not. There are times when some portions can qualify and some cannot. And it's quite shocking if the fund managers think the entire amount qualifies in that exit, but only part of it does. And really, QSBS analysis should be an ongoing exercise if it is done properly. And with that, we'll move into our next polling question.
Great, thanks, Ashley. Yes, polling question number 3. Are you considering 2023 state PTET election for GP entities and or management company? A, yes, 2023 payments are already submitted by due date. B, no, perhaps we need to talk more with our tax advisors. See, that we have been doing this for years. For those of you who would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email after the webcast. Also, feel free to submit your questions in the Q&A box located on your console. And we'll give people just a few more minutes to respond, or moments. All right, here are the results.
Okay, looks like 42.9% of you might need to give me a call. And with that, I'll move it on to Diego.
Great, thanks, Ashley. And hello, everyone. My name is Diego Aguirre Torres. I'm a manager with the Valuations Group. For this portion of our presentation, we thought it would be interesting, now that we've had a few years in a high Fed funds rate environment, to take a look at how company valuations have been impacted, and also how companies have responded in the midst of these higher rates. All right, so first we'll take a look at how the Fed funds rate has changed since the COVID-19 pandemic, and we'll also observe changes in other rates. Next, we will take a high-level look at the components of a discount rate, which in finance theory is a key factor in estimating the value of a company. Finally, we will take a look at how company valuations have changed since the COVID-19 pandemic. And for this exercise, we track various metrics of public software companies, which perhaps were one of the more sensitive groups to changes in these rates from a valuation perspective. Okay, so in response to COVID-19, the Fed kept the funds rate near zero in the hopes of increasing economic activity. You can see the effective funds rate in that blue turquoise line in our graph up there. Then, in early 2022, the Fed instituted a higher funds rate policy in an effort to try to tame inflation. As we know, inflation had picked up drastically, partially as a result of this policy, but perhaps more so because of the fiscal stimulus and supply chain challenges from the COVID-19 pandemic. Now, the other two rates shown are prime rate, which represents the cost of debt or the cost of borrowing, and we also have the 10-year Treasury yield, which we will think of more as an opportunity cost. Now, before we move on to the next slide, earlier we mentioned that in finance theory, the discount rate is an important factor in estimating the value of a company. And that is because typically market participants tend to focus on present value of the cash flows produced either by an investment or a company, and we use the discount rate to present value those future cash flows. Now, we won't spend too much time here, but we wanted to provide a high-level look at how the Fed funds rate policy impacts how we think about company valuations, more so from a mechanical perspective. Now, a weighted average cost of capital is a common example of a discount rate used in discounting future company cash flows. Now, as you can see from the two arrows here, we've highlighted the interest rate on debt, which can be exemplified by the prime rate we noted in the previous slide. And then the risk-free rate or opportunity cost is exemplified by that 10-year, again in that earlier slide, and both are part of the buildup of a weighted average cost of capital. So all else equal, the Fed fund rate changes have pushed that discount rate higher, thus lowering the value of those future company cash flows. So we've set the stage here by first understanding how the Fed funds rate has changed over the last few years. We've observed similar changes in other key rates, and now have a basic understanding of how those other rates fit into the calculation of a company discount rate. Now, in the next few slides, we'll see how valuations have changed for a particular group of companies. Now, our data set is comprised of the mCloud index put together by Bessemer Venture Partners. Now, as we mentioned earlier, the valuation of these particular companies were among the most sensitive to changes in Fed funds rate. Now, why might that be? Well, one reason might be because many of these companies are not yet mature companies or in the earlier stages of their company life cycle. So the bulk of the cash flows produced by these companies can be multiple years down the line. And a higher discount rate may impact the valuation of those far out future cash flows, probably more so than a company that is already producing steady cash flows or a company that is more in the mature stages of their life cycle. Now, this is not the only reason why company valuations have changed, particularly for this group of companies, but it's definitely a consideration. Okay, so here we have the median market capitalization of the mCloud index through the same date range as in our earlier rate slides. We've also plotted the median revenue metric of the same group. Now, what is interesting in this first slide is how the median market capitalization peaked in October 2021, around the time the Fed funds rate was near zero. And once the Fed signaled and instituted their higher rate policy, market caps have come down. And yet, as we can see by the green line, the median revenue metric has been steadily increasing, which in a way seems a little bit counterintuitive because the revenue metric seems to indicate that companies are performing as expected, but valuations have come down and do not appear to be increasing at a similar rate. Now, when we take a look at additional data, so the next slide appears to show a similar trend. Here we're looking at revenue trading multiples for the same group of companies, and we're looking at free cash flow margins. So as we can see, multiples have come down and have been in a range since about June 2022. But free cash flow margins have been increasing beginning around the same time those multiples began bottoming. And yet we have not been able to get back to the multiples levels seen in late 2020 and in early 2021. Now, perhaps what we can glean from this data is that companies, particularly in the software space, are resetting priorities. The focus appears to be more in generating free cash flow while growing revenue in a sustainable manner. So to summarize, the Fed funds rate policy appears to have had an impact on how market participants think about company valuations. We can see that from a mechanical perspective, for example, the discount rate or the weighted average cost of capital calculation that we looked at. And we can see how companies are responding to these economic shifts by focusing on generating free cash flow. Now, if we had more time, looking at similar data across different industries could provide us with more insight into these dynamics. But moving forward, it will be interesting to see how potential shifts in the Fed funds rate policy will change how market participants view company valuations and how these companies will prioritize their financial metric objectives. Now we will go on to our final polling question.
All right, thanks, Diego. Last polling question. What will the Fed do as it relates to rate policy at the next FOMC meeting? A, keep rates steady. B, cut rates. C, hike rates. Once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window. We'll give everyone just a few more moments to respond. All right, and we'll pass over to the results.
All right, so it looks like the overwhelming majority thinks they'll cut rates, which is, I think everyone's been kind of in that. That's what we've been hearing, and that's what has been in the news. So, yeah, we'll see what happens. Now we'll kick it off to Syed for remarks.
Thank you, Diego. Well, thank you, everyone. I would like to extend our big thanks for presenters for the hours they spent preparing for the presentation. It was wonderful. We landed right on time. So we'd like to thank our attendees for attending our webcast today. For any Q&A, we have some questions coming in. We have jotted them down, and we will get back to you with the responses later. We have all our presenters' contact information. So please, if you feel like you need to reach out to anyone, feel free to reach out, email us. We are here to help and answer any of your questions and hopefully connect with you. Lastly, I would like to remind everyone, December 11, 2024, we have our Alternative Investment Conference, which is our annual conference. We have an excellent agenda. One of our keynote speakers is a former rock band musician turned venture capitalist. So that should be interesting. We also have a wonderful panel being set up. We will speak with our venture capital investors. So please don't miss out. And we will go on an expanded coverage on a lot of the topics we covered and some of the topics that will happen over the next few months, especially after the election. So please don't miss our conference on December 11th. We will be sending out more information later on the conference. And with that, we have more insights articles on our website. Here are some links. You will get this presentation later. So please go check them out. And if you have any questions, as always, feel free to reach out to any one of us. And with that, Laura, I will turn it over to you to take us home.
Great. Thank you so much, Syed. And thank you, everyone, for a great presentation today. As he mentioned, if you submitted a question, we'll do our best to follow up with you after the webcast. But also feel free to reach out to any of our presenters, also, as he said. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And please fill out the link to our survey. Your feedback is always appreciated. Again, thank you for joining us, and take care, everyone.